Hey guys, welcome back to the channel. In today's video, we're actually going to start off a little three-part mini-series, which is just going to be based around how to read the financial statements of a company. Now, as you know, or as you may or may not know, every company has the three major financial statements. And if you're going to analyze companies, it is extremely important that you actually know how to read these statements. Now, these are, of course, the profit and loss statement, or the income statements, the balance sheet, and of course, the cash flow statements. And in today's video, we're just going to start with the income statements. We're just going to go over some key metrics that I like to look into when I'm looking into a company's financials. You know, just explain what they are and why it's important you look out for these. Hey guys, so we're actually at the computer now and we are looking at an example of an income statement. So for this one, I thought we would use Apple as a good example of an income statement. They've got a nice, clean, and really simple income statements, right? Not a whole lot of rubbish in there, and it's got some of the real key metrics that I like to look at when looking at an income statement. So this is actually pulled from their 10K file, their annual report, the latest one. Now, when you look at an income statement, the first thing you're going to see, right? So here they've got it as total net sales. This is also known as your top line, right? Because usually in an income statement, it's going to be the very first line that you're going to see. So it's your top line. This is total net sales, also known as revenue, right? So that's your number there, right? Basically, all the money the company got from, selling goods and services, right? So that's going to be your revenue, right? The next number you're going to want to see, the next number you'll see here is your gross margin, right? Or also known as gross profit, right? So you get your gross margin or profit by subtracting the total cost of sales, right? So this is the cost to produce the products and whatever, the products and services. You subtract the total cost from your revenue, and you'll get your gross profit or gross margin. And then as we move down a little bit further, we'll see here operating expenses, R&D, selling, general and administrative, and then sort of operating expenses, right? You get down to your operating income. So this is also known as Ebits, right? So if you see EBIT around a lot, EBIT is basically earnings before subtracting interest and taxes, right? Interest, expense, and taxes, which right below your operating income, you'll see, income expenses, income before provision for income taxes, right? So, and provision for income taxes. That once that all gets deducted, you'll then come down to your net income, right? And your net income is also known as revenue. Sorry, my bad. Net income is also known as your earnings. So this is going to be earnings. You'll hear a lot of that when you're looking into companies. Basically when you see them do earnings reports, that's what this is mostly what they're talking about. Net income is also known as earnings. It's net of all these expenses and obviously the cost of sales. So we come down here and we would actually see earnings per share. Now, earnings per share is really important because this number here, basically what it does is if the company was to hypothetically pay out all of their all of their net income, all of their earnings, right? If they decided for whatever reason they want to pay it out to all their individual shareholders, this is what you would get per share, right? So remember, when you're buying a company or when you're buying a stock, you are buying, basically, you have rights to the company's earnings, essentially, right? So this is what you would be getting on a per share basis, right? So you want to use diluted. So your basic shares outstanding, right? Basic is just talking about the common shares outstanding, right? But your diluted number, this also takes into account all of the other preferred stock or the shares that are used for compensating, that have yet to be converted into common stock, right? So things like the stock that they use to compensate CEOs and all of that. So I personally like to use the diluted number, right? It's a bit more conservative, and in my opinion, it's a bit more accurate. And then down here, you just see shares. Basically, this is just the company's shares outstanding, right? Which just means this is just all the shares that the company has out there in the market at the moment, right? Now, ideally, you want to see this number decreasing. Now you see here in Apple's case in 2018, you can clearly see 2018-19, the number is actually decreasing, right? Which means there's not a whole lot of dilution going on in the company right now. They're actually buying back their own stock, right? Which means they're giving you a bigger piece of the pie. Now, when you're looking at an income statement, right? It's always kind of important to look across, not just look at 1 year, right? You want to look across a range, right? A range of years, right? And the reason why that's important is because then you can actually kind of see straight off the bat whether the company is growing or not, right? So for revenue, right, you want to see this number growing, right? You want to see that number growing or at least staying steady. And then, same with the your gross profit, right? You again, always good to see that number growing. And then you've got your EBIT, the operating income, and your net income, right? It always depends. So net income, there's a lot of things that goes into it, right? Not necessarily this could fluctuate, right? You don't always expect to see this in a linear fashion, kind of going up, year on year and year on year, right? It's rare that you see that because net income. It's 1 year the company's tax might have to pay for whatever reason. They might have a provision for income taxes higher than the previous year, right? So, but it is always important to keep an eye on the earnings, right? You do want to see that at least steady. And so once you've looked at it, once you've actually looked at if you're looking at the 10K, if you really wanted to do a deep dive, you'd actually go into a website like Ticker, right? So I've actually got Ticker already opened up here, and then if you go into the financials. Apple's financials. So you see Ticker kind of has a bit more of an in-depth look at the company's financials, right? So for example, now we've got a broader range to look at. Now we're looking from 2016 to 2020. And then you can see here, right, top line revenue, right? So again, like I mentioned before, the top line is the company's revenues. And then you'll see Ticker does things like let you know what the change year on year is, what percentage wise. And you can see straight away that Apple's revenues has been kind of fluctuating. It's been kind of going, 1 year they're down 7.7% from the previous, and then they're up 6.3, up 15, down 2. Now for a company like Apple, normally that would be pretty, well, not saying concerning. It depends on what the situation the company's in, but you want to at least see a steady pattern, But for Apple's case, because they're such a large company, right, trillion-dollar company, it's difficult for them to see, large growth, right? Now, you've got the revenue top line, and then you've got here gross profit or the gross margin. Right now, you can also see year on year, you can actually see that again, it fluctuates a little bit. Now, if you're really doing a deep dive in Apple, you might want to actually go look into this year, see what happened, why was this down from year on year, and also maybe in 2019, see what happened there. But you can also see here that Apple's gross margins, right, is pretty steady. You can actually see here from 2016, they've been hovering around, it looks like, 39% gross margins, right? So this gross margin is basically, what percentage of their total revenue, right, is profit, right, is their gross profit. So you can see here they've got really healthy gross margins, 39%. Ideally for some, for most companies, I personally like to see a company with over 10% gross margins, right? But this is where your understanding of the company and the understanding of the industry that the company's in would come into place, because there are industries where single digit gross margins, because they're so capital intensive. But obviously for a company like Apple, because they sell a lot of software and also they do sell products, you see here they have some really healthy gross margins, right? So this number here, you do want to see this at least. Ideally, for me as a benchmark, I do like to see it above 10%. You've got here this, the R&D expenses, the selling and general AE, and then you've got their Ebits, right? You see their Ebits again kind of falls in line with their revenue, and then you've got their operating margins. Right, and again, you can see it's pretty steady. The operating margins are pretty steady. We come down and then we see their net income, right? Again, using a site like Ticker will actually allow you to compare data across a range. It's always good when you're looking at financial statements to kind of see them year on year, side by side, so that you can actually see the growth, or you can actually see if there's a pattern occurring. So you've got net income to the margins to revenues basically, and then you've got down here, Ticker actually then adds in some extra data, right? This isn't, you don't actually find these in most companies' income statements. This is just supplementary data that Ticker adds on. And then you can see here weighted average diluted shares outstanding. Again, for something like this, you want to see this number decreasing, right? So this is just the average number of shares that the company has outstanding in the market, right? And you can see with Apple from 2016, they went right down from 22 million right down to 17. They are buying back a lot of stock. And the reason why it's really important to when you're looking into dilution, right? So basically, when you're looking into the shares outstanding and whether dilution is occurring, you want to think of it this way, right? So if a company is issuing a lot of shares, right? So say a company has 10 shares and you bought 5 shares, you are now a 50% stakeholder of the company, right? Now, if for whatever reason that company decides to raise some, they decide to dilute the shareholders, right? So they need to raise some capital, so they decide we're actually going to issue 10 more shares, right? So just because they issue 10 more shares, it doesn't mean they give you any, any extra shares from those new shares that they're issuing. So what actually happens is now there's 20 shares outstanding. You still own your 5, right? So you went from someone who owns 50% of the company to 25% of the company, right? So you can see all they've done basically, they haven't increased the pie, they've just increased the number of slices in the pie, and in doing so gave you basically a smaller piece of that pie, right? So really important that you keep it, it's really important that you actually keep an eye out for dilution. Another reason why it's important to keep an eye out for shares outstanding, like the shareholder dilution, is because if a company is growing their earnings and their cash flows, right? If the cash flows was actually growing by say 50%, right, year on year, annual, like compounded 50%, right, for example, but on the outset, right, on the surface, that would look amazing. You'd look at them and be like, man, this company is just killing it right now, 50%. But then you dig a bit deeper in and you actually see they're also diluting their current shareholders by 25% every year, right? So realistically, that company is only growing their cash flows by 25%, right? That growth is getting offset by the dilution that's happening, right? There's a lot of they're just issuing a lot of shares and decreasing your ownership in the company, right? So that's why it's pretty important to keep an eye out for the shares outstanding. Right now, you want to see that number either decreasing or staying steady. There is obviously different situations where it would make sense for a company to issue more shares. So just a quick example of that. So if the company, for example, was extremely overvalued, right? Let's just say I knew for a fact that they're worth $10 per share, right? And they're actually selling at say $40 per share, right? Extremely overvalued, and the management actually knew that their stock was actually selling well above its intrinsic value, right? In that case, it would make sense for them to then raise capital, right? You're basically selling really expensive shares, right? Taking advantage of that mispricing in the market, and then using that, they could actually then use that capital to acquire companies, right? For acquisitions, which could then grow the company, which would actually then be good for you as a shareholder, right? Depending on whether that acquisition actually works out. But in that situation, you can justify why they would actually issue more shares, right? You just don't want to see a company issuing shares willy-nilly, or issuing shares because the CEO or the board or whoever has stock options, right? And they're just trying to pump up the stock as much as they can so they can get that payout from their stock options, right? So again, we'll kind of went on a bit of a tangent there, but that's where looking at the shares outstanding is pretty important and actually plays a big role at the end of the day. And then you've got here, so again, basic EPS, you got your dividends per share. Ticker actually does a really good job of saving you a whole bunch of time if you're looking into these things by providing all this extra information for you. They've even got the company's EBITDA down here for you, right? You don't have to actually, because you wouldn't get this in the income statement. You would only get Ebits, the DA, which is depreciation and amortization. You would actually have to get that from, I believe it's the cash flow statement. I want to say it is, right? I want to say you get that from the cash flow statement, right? The depreciation and amortization. But basically, EBITDA is just the raw earnings. It really helps you. You can use EBITDA to kind of compare apples for apples, right? Companies across kind of industries, right? Because it just takes into account the earning, just the company's capability to earn, taking away the interest and taxes, and before they do their magic with depreciation and amortization. That's what EBITDA is, right? That's just a really brief explanation of EBITDA, but you won't find this in the income statements, and this is a ratio we'll definitely go over in another video. But yeah, so that's basically the key things that I like to look at. Ooh, low battery, so we better Hurry up. So, but that's basically key things that I like to look at when, looking at an income statement, right? So one, just a quick summary, you got your top line, your revenue. You want to make sure that number is growing, right? It doesn't have to be a certain amount, grow by a certain amount, but ideally you do want to see that growing, right? And then you've got your gross margin or your profit margin, right? You want to make sure the company is profitable. Sorry, that doesn't necessarily mean the company is profitable, but you do want to see healthy margins, right? Healthy gross margins, and then you've got your Ebits, right? And then your net income, right? So net income, also known as earnings, okay? And then you have here your earnings per share, right? So the key things I like to take away mostly from an income statement, especially if I was looking at an income statement like this, I would check out their revenue, make sure that's growing, check out their gross margins, make sure that's healthy and growing. You want to get your earnings per share because at the end of the day, as a shareholder, this is what you'd be getting if the company decided to pay out all their earnings, minus any preferred dividends and whatnot. This is where you get your EPS, and then you obviously have the shares outstanding, which again, what we've just gone over. You want this number either steady or going down, right? And if they are increasing, if you're seeing the company is actually issuing more and more and more shares every year, that would raise a red flag. I would then actually do some digging and find out, why exactly are they issuing shares, right? Is the company overvalued right now? Are they trying to make an acquisition, or is the management, just trying to, selling shares and using the stock options just to get a good payout, right? So, right, when it comes to shares outstanding, that's something that you really want to look out for. Really important for you to keep an eye out for, right? Now, that's basically the income statement, guys, right? So those are some really key, some basic things, some key metrics that I like to look at when I'm analyzing a company, when I'm looking at a company's income statements. If you really want to go deep into the weeds, that's where the other two financial statements would come into place. And altogether, they kind of build up a story of the company's financial health, right? So if you stuck around this long, if you got some value out of the video, do make sure to like the video and subscribe to the channel. Like, if you don't want to subscribe, then like the video, right? I mean, it literally takes 2 seconds. So make sure to like the video. If you enjoyed this one, there's plenty of other videos on the channel. I'm actually going to link a couple of them on the screen right now. Click on them because they're actually going to help you become a better investor, and they'll actually and hopefully add some value to your financial journey. But until the next one, guys, I definitely look forward to seeing you guys then.